Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Each and every week, we bring you information about mortgages, mortgage rates, what affects the mortgage rates, how the real estate market is going, and all these things, maybe some information you need in order to make a decision. Maybe you need to make a decision, you want to make a decision, you're trying to help a family member. There's all kinds of reasons you need this information. Now, there are other places to get it. It's an easy way to get it if you just listen to the radio or see us on YouTube. If you go to the radio, we have 5 stations, 3 states, Albuquerque to Las Vegas, Nevada, in the Inland Empire, in Southern California, as well as up in Tahoe area. All of these programs on these stations, really on the weekends. If you go, Daryl, do you know what the times are, some of these stations?
I know some of them. I know that it's on KMET in Banning, California. It's on at 10 a.m. on Sunday morning.
Okay.
I know that on K Tahoe, it's on at 10 a.m. on Sunday morning. KMIN, I think, KMIN, I don't know actually what, I think you talked to Derek on that.
Yeah, I think, and that's down in Albuquerque for you who are listening down there. The show, I believe, is on in early afternoon on Sundays.
In Las Vegas, it's on Saturday afternoon on KSHP.
And we're also, KCAA, which is our largest, I guess, station that we're on like 3 or 4 times during the week. And that's out in the Inland Empire, too.
Every time you turn around, here we are.
Thank you very much. If you want to hear us other than the radio, we are on the major 8 podcasts. I think, Daryl, you have the list of those as well?
I do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and, of course, YouTube, as you had previously mentioned.
Excellent. And on YouTube, Jeff Barton, the Mortgage Voice, you can go there. You see the show. We shoot the show for TV. Some of the radio stations carry a video feed when we are on those stations on the weekend. And again, like I say, YouTube will carry it. We also do a 2 or 3 minute quick mortgage minute on a daily basis. We're on LinkedIn and YouTube and Instagram, and we try to get to Twitter, a couple of the other feeds, the social media feeds. And that's called the Mortgage Minute. That, too, is on YouTube, Jeff Barton, the Mortgage Voice. Thanks very much for tuning in again. I want to just get right to some of the things that are on my mind. We had an election. The election is over. We're not quite sure who wins or who loses. But regardless, how does that affect rates? How does it affect supply of housing? How does it affect the decisions being made at FHFA in terms of oversight? How does that support or hinder your ability to go get a mortgage? It doesn't. None of this affects any of that because the federal government is not in the business of building houses, nor are they in the business really of setting rates. I know that if you go to any website and you see that ad, the Fed has cut mortgage rates to blah, 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 and you can now get an interest that, well, the Fed does not do anything with mortgage rates, has nothing to do with mortgage rates. What the Fed does is arrange rates from either the Treasury or from bank to bank. They do not regulate mortgage rates. Mortgage rates, everybody knows, that's the bond market. The bond market is regulated by how much yield you are selling each bond for. Yield goes up, so does the rate. Yield goes down, so does the rate. Because when there's high demand for the bond, the yield or the money you have to pay somebody to buy these bonds goes down. And that really brings down the interest rate. Now, we've dealt with interest rates at a low of low lows last couple of weeks. We ticked up a little bit, although we are in the same range we were at the beginning of October. We're now in the second week of November, and really for the last 6 weeks, we've seen 1/8 of a point either way, and that is the way we are today. Let's get right to it. 30-year fixed rate is at 3.01. The 15-year fixed, 2.48. The FHA loan is at 2.45. The jumbo loan, 3.42. The 5/1 ARM at 2.88. Now, there's a reason you do all these kind of loans or make a decision about which one you want to do. And these rates, this is really an average of the rates across the country. Well, what does it mean? It means if you've got a decision to make about what product you want, about whether you want to do 15 or you want to do a 30-year. And there's real reasons to do both. Now, some lenders out there will still do a 20-year too. And there are ways by which you can have a 30-year loan to really pay it off in less time, 10 years less, maybe even half. It's about how you pay the mortgage. If you can pay at a certain rate of payment, rather than doing 12 payments a year, you can do 14 payments a year, thus making one extra payment per year. And I think that the way that is done is if you do it every 2 weeks rather than on the 1st of the month or the 15th of the month or whenever your mortgage rate is, your mortgage note is due. That's the important thing in that particular aspect. But all of these carry with them, look, if you've got great credit score, is what I'm trying to say, and you are great income, all of these rates apply. But a lot of them don't apply if you have a ding on your credit. What does that mean? You have a 30-day late. You haven't paid a mortgage within 30 days on time within the past year or the past 2 years, or you have 2 lates. These are going to affect this is going to affect your credit score. Your credit score is about risk. Risk for the lender means higher rate. That's just the way they look at it. And I don't know if you understand why that is, but let's say that you didn't pay off a student loan. That's going to affect your rate. If you didn't pay off a car loan, of course that's going to affect your rate. Let's say you had a bankruptcy in the last 7 years, that's going to affect your rate. Now, does that prevent you from getting a loan? No, it doesn't prevent you from getting a loan, but it does prevent you from getting, the best rates, the ones I'm talking about here. And because everybody hears or sees, rate at a certain thing. And that's one thing about the mortgage industry that you have to understand. You are an individual. You got to get out there and find out what you are, your credit score, your income, your ability to repay. What is your loan application look like? What is the loan to value? What is the house valued at? Whether it's a refinance or whether it's a purchase. All of these things are going to factor in you, the person who needs to get that loan. A couple other things that I wanted to get to within the scope of what I'm talking about news-wise, forbearance extension. So if you had a forbearance, and I mean, if you in early March, middle March rather, lost your job, couldn't pay your mortgage or pay your rent, you were given something called a forbearance or the ability to apply for a forbearance, meaning that, hey, I can't pay, put it on hold, I'll get back to you in whatever the time frame is. Well, they've just extended the time frame until December 31st of 2020 in order to apply. For this entire time, you've had the ability, because they keep extending it, to say, okay, I could have paid, I did pay the first 2 or 3 months of COVID, now I can't pay because I lost my job. Well, the significant part of that right now, extending through the 31st of December of 2020, is the fact that what we have right now is the pandemic, the COVID virus, really sucking it to us, right? 120, 130,000 new cases on a daily basis for a week. Since the election, it's been terrible. Since a month before the election, you saw it build. They call this the third wave, right? Everybody knows what it is. But what it means is, because of this extension, it allows you time. Let's say that right now, your company says, hey, whoa, I gotta stop. I gotta shut down my business for a while because of COVID, and you lose your job. You can still apply for forbearance on your mortgage or on your rent. And those things are important until we get some sort of stimulus package. And when we get that, if we get that, I believe we will. I believe it'll be smaller than what I thought it was going to be prior to the election. And shame on both the Democrats and Republicans for not helping out people who really need the help. I mean, come on, this is not a partisan issue, but made a partisan issue to affect the election. I hate politics because it affects people who have no control over what's going on. Kind of like the stock market for the individual investor. You have no idea what's happening in that market. You're just trying to ride waves. But at any moment, the rug can be pulled out from underneath you and everything you've invested can be gone. That is true not only in that, but it's also true with this stimulus package. However, pontification over, I do believe we will get a stimulus package somewhere down the line, and I do believe that stimulus package will be able to help those people in need, those people who need, obviously income assistance, as well as forbearance extension, some way by which to pay their bills. Certainly states and counties need it in order to continue to pay their employees. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, and I'm your voice in the mortgage industry. Thanks for tuning in each and every week to the show. We're glad to have you. We're on 5 stations, 3 different states, or 3 stations in 5 different states. I'm a little confused right now about a lot of things going on in the world. Maybe you are too. Trying to sort through whatever this election is for you. We're just trying to figure out how that affects your rate if you want to get a mortgage. Maybe it affects your ability to buy a house. But I don't think so. Most of this stuff is dictated by trends that are way, 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 way bigger than just this election. One of the trends is, of course, the COVID situation, which has, rendered just under 3 million people in forbearance. Forbearance is, of course, not paying your mortgage. The government has allowed that to happen without any penalty. They've made an extension to that until the 31st of December this year, as we've covered earlier on the show. One of the things that I think is important to understand is that these large events that happen and how they affect you and how they're going to affect future borrowing or future buying of real estate. When we got through the summer pretty well, and most of the real estate agencies and agents, mortgage brokers around the country really figured out a very efficient way to handle either showings or closings or fundings or inspections at the home. Most were done remotely, or if there was contact, it was done in such a way by which it protected both the seller and the buyer and everybody else involved in the transaction at the property itself. And certainly the lenders that mortgage loans are submitted to, they've gone to a stay-at-home structure a long time ago. Now, the larger companies, Quicken and United Wholesale and some of the others, they have underwriting staff and they have their own ways that they deal with interaction between you and them and them, and then, of course, funding and transferring title to your name. All of these things have been really dealt with very smoothly during this pandemic. So what are we dealing with now that we are at the end of this cycle? We seem to have a vaccine just on the horizon, yet we're still in a bit of a morass and not quite sure what's happening, whether it's coming or going with one administration or another. As again, I say, don't get lost in the confusion of the moment. Keep your eye on what really is important, which is the mortgage rate. What's the term, meaning how many years you want to pay it, and can you get into that property? I think the most important part of it is, 1 second, I think we have Cindy Bui right with us. Cindy Bui comes to us from CAM Financial to talk to us about what's going on in the market, what's happening in her business, where does she see things going in the future. Cindy, how are you?
I'm good, thank you.
Excellent. Okay, first of all, are you tired from all the business that you have?
I feel blessed, but yes.
Yes. Uh-huh.
Yes, I'm very thankful, but yes, it's been coming in an abundance. Yes.
I know. And is it mostly a refinance, or is it a combination of refinance and purchase?
It's a combination of both, but I guess my market, I've just been doing most of them for me, it has been refinances.
How do you think rate is affected when a lender looks at a particular borrower more? Is it by how much money they make, or is it by their credit score?
It's more, I guess, both. It's all about debt ratio. So as long as it fits in the guidelines, I think it's all that matters.
And what do you see?
It's a combination of both.
I see. What do you see as the most in your particular business right now? What are you looking at? Are you looking at pretty good FICO scores still? Are you still looking at people who are earning a living? As you know, ability to repay during COVID has been somewhat of an issue.
Well, it's for me. It seems like people that I've worked with, they still have good credit. So it's a mixture. It's a mixture of both. But maybe it's because of the CARE Act and everything.
Right.
You know, the stimulus has been helping. Homeowners and people be able to save money, and it's been able to preserve their credit, maybe. But so far, I've seen that. A lot of my clients, they still have decent credit and they've been making their mortgage payments.
Okay, that's excellent. So I know that the actual forbearance program is down to under 3 million now. It sounds like a lot. Spread over 50 million loans, it's really not that much. Programs with your clients, what are you mostly doing? FHA, conventional? Are you doing jumbo products? What are you doing?
I'm mostly doing conventional with a handful of FHA, and I have not been doing any jumbos unless they're high balance, but not any. I haven't been doing any jumbos. It doesn't seem like it's a market for jumbos right now.
Right. Have they now issued the new whatever the conforming limits are in each county? Has that come out yet?
I haven't checked. Not that I have seen. I have still been just going off of the 765, 500. So I haven't seen it yet if they have.
Right. And could you explain to people?
I haven't been put in a position to have to read that yet. Have they?
No, I was going to ask you, tell people where you do most of your business or some of your business or all of your business. I know that you're in multi-states, but if you could explain to people, as you know, we're in a bunch of different places too. So you might as well tell people where you're doing most of your lending.
Well, I mainly do my lending in California, with maybe a handful here and there in Nevada, but a lot of my clients are in Southern California, in Orange County and Los Angeles. So I've been doing a lot of, just regular conventional conforming, people that are just trying to lower their rate, taking advantage of the rates that are in the twos right now.
Yeah, that's true. I see the rates fluctuate a little bit. They went up some today.
Yeah.
Yeah. And do you think that that's because of what's happening politically? Although I don't think so, but what do you think?
They say, based on what I was reading, they say it was because of, the promise for a vaccine that's coming out soon. And I guess that's supposed to bring stability into the economy because people now feel safe to do things. And so that's what I was told, that's the reason why the rates are starting to go up, because they're starting to feel like the economy is going to stabilize because of the vaccine.
So people will take their money out of wherever it is and put it into stocks. Therefore, you have to offer more in the yield of your treasuries. That's why, I guess.
That sounds like it, yeah.
In your purchase market, what are you seeing as the impediment to getting a buyer a particular property? I know most of the properties out there have multiple offers. Are you seeing that too?
I know, yeah. So, I'm sorry, can you ask the question one more time?
Sure. What do you see as the impediment? What's the main issue to getting your client into a home if they're competing with other borrowers for that particular purchase?
What's the main thing? Oh man, that's a tough one. I hate to say it, but sometimes I feel like if they don't want to compete, they might have to, just look at other homes that have potential to look nice.
Right.
And not look at, like a lot of houses, if you love it, then most likely 20 other people love it and will put an offer on it too. So you might have to look at something where it might not be beautiful just yet, and right. There might be potential. So with that house might have less offers. That's the only thing I can truly think of. Or just not give up, just keep on going, because I'm a strong believer that a house is particularly made for a specific person. So if you didn't get it, maybe it just wasn't for you. And just keep on going. Don't give up.
Good idea. Hey, Cindy, shout out your phone number for people that want to get a hold of you if they need a terrific loan broker here in Southern California.
Okay, sure. My phone number is 403-7400.
Cindy, thanks for coming on, and I really appreciate you spending time with us. I'd like to get you back on maybe for a little bit longer of an interview. But again, thanks very much for coming.
Okay, you're welcome. Have a good day.
You too. That's Cindy Bui from CAM Financial. I'm Jeff Barton, your voice in the mortgage industry, and we will be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in each and every week. Thanks very much for listening. We bring you some information that's going to be useful. If you listen each and every week, you will certainly get a flow of the information that we get, mortgage information that changes weekly, daily, sometimes not at all. But this week it has, because there is some volatility within the market and some uncertainty. Markets don't like uncertainty, and what happens? Rates go up. So in order to talk about that, as well as some of the terrific products that they have at Stearns, is Wendy Van Wessel. She's been on the show many times with us. Recently, not so much, but I'm glad to have her back. Wendy, thanks very much for coming on the show.
Thank you, Jeff. Thank you for having me.
Okay, very good. All right, let's talk about that volatility. Let's talk a little bit about why rates are rising. What is the deal?
What is it that they say that if the stock market does well, it's not good for the rates? If the stock market does poorly, then it's really good for mortgage rates. That's usually the way we look at it. But there is volatility because of the precarious place that we find ourselves in right now. I don't know what to expect. So I see a lot of ups and downs on that 10-year Treasury, and then also on the 2% coupon out there, especially in the last few days. So if you have a loan and in the process of doing a loan, it might be a good time to lock.
You know, you talk about coupon. Explain that a little bit to the people, because a lot of people don't really understand. When you buy something, you're buying it at a particular rate, and that particular rate gets put in with a pool of other loans in like-minded rates, and then that particular coupon or so is what they sell to investors. Explain a little bit more about that.
Well, there's Freddie Mac, Fannie Mae, and Ginnie Mae, and we all pool. Lenders will pool the loans of like-minded rates, like you just said, and they will sell it because investors are looking to invest with rates that are, say, at 2.5% or 2.75. They like those rates because they think that they'll perform well, that the people will keep their loans longer, and that they'll make money on the servicing of those loans. And that's why when you look at rates, sometimes a 2.5% rate versus a 2.75 rate might price better than that 2.75 because that particular investor is paying better on those pool of loans. So it's always good to look at all of the rates in your vicinity that you want to see which one gives you more yield spread premium to pay for closing costs, to pay for other things on your loans. And that's what the loan officer does for you, because they look at all those different rates and what gives you the best amount of money. How much will your mortgage payment go up with that 1/8 of a point difference in the rate, and how much will you be getting back in money with that higher rate for your closing costs and other things, and how long does it take you to recoup? Sorry, that was a long answer.
No, that was good. No, I mean, maybe people who are hearing it don't really follow it, but it explains exactly what the issue is here and why rates do go up, because there are limited amounts of loans for each pool. And depending on the volatility in the markets and the spread by which you can offer on the back end to either, as you said, for closing costs or other purposes, this is all in the important aspect of what happens in the mortgage market beyond just the 10-year note.
Correct.
So tell me, where is it all heading?
Poorly, I would look to see if the rates are doing better, because that has been a general compass for a long time.
Right. Right. No, I think that the 10-year note is exactly what we all look to. We preach it on the show a lot of times, but when you have the Fed purchasing mortgage-backed securities as well as the 10-year note to the tune of $120 billion a month, well, it really kind of throws the supply and demand curve way off. So you look to other places, volatility in the market, the economy, as you were talking about how bonds are bought and sold on the secondary. All these things are going to affect rate. do you think volatility within the rate market is here to stay, or do you think it's short term?
Well, I think that we will have a low rate. It'll continue to be pretty low, pretty good market. I think more for purchases than refinances. If you look
Okay.
at the MBA mortgage financial forecast, they expect there to be like $2.5 trillion worth of loans in 2021, and that's up.
Mhm.
That's up by 250 billion. So there's going to be a lot of movement out there, and for that reason, I think it's because the rates are going to stay lower.
Right.
Right about here, but there will be daily jumps up and down with what's going to happen and what's going to happen. Look what happened to the yen the night before the election. The yen dropped.
I didn't see it. I'm sorry. I don't follow currency exchanges. But
But it was a forecast. So things that happen in the world also affect the rate.
okay,
And
no, we
credits are no longer going to be owned by the government. Is that what they're trying to do?
yes,
So,
FHFA is pushing, is that what you mean, Fannie Mae and Freddie Mac out of conservatorship? Is that what you're talking about?
yes.
Yeah, that's happening. That's a good thing, by the way. That's not a bad thing.
Okay. Well, maybe the listeners want to know why it's a good thing.
Well, the reason it's a good thing is because you get into the free market system as opposed to government-backed loans. Now, you may end up on the short term paying more for your particular loan, but you will also get more competition in the marketplace, which eventually will drive the loan down, the loan costs down, and also offer more products.
I always believe in putting things in the marketplace, supply and demand.
Yep.
I agree with you, just like insurance, too.
Yeah, no, and you know something about insurance too, having that ability to be able to either get title or regular health insurance or your homeowner's policy. Yes, more competition is better. There's no question about it. So tell me about products over at Stearns. What's happening there?
We have got our jumbo products back again, and they are
Okay.
quite well. You know how the banks always had the really good rates, but people had to be really careful how they filled out their 1003, which is going to go to, 9 pages now instead of 4 soon.
Unbelievable.
But they had problems filling out the loan the way it was supposed to be filled out, so they would a lot of times get kicked out by banks, and the brokers couldn't really compete with the rates the banks were giving because they had taxpayer money to fund those loans, right? All those
Right.
banks. So now we have our jumbos back. They're pricing in the high twos, but you have to have a low LTV. You have to have a good debt ratio and decent FICO score, but they're back.
Oh, that's good. And what are you talking about LTV? Are you talking more like 70%, less, more?
They go to 80%, but if you
Okay.
like a rate in the high twos or somewhere around there, decent rate for a jumbo loan, because even an eighth of a point makes a difference on a jumbo loan. We can go to
Yes, it
$1.5
does.
million. I had a 67% LTV, not supposed to quote rates, but in the high twos, I'll just say. And it was a 770 FICO score. So remember to keep your credit cards under 30% utility or less. And remember not to make a late payment because your FICO score is important if you want to do loans. And the way you do your taxes, too. Don't always listen to those CPA people if you want to do a loan.
Well,
Run into
yeah, I
that
mean,
all the time.
I think in the tax situation, unless you're going non-QM, which you guys aren't doing currently, yeah, you really got to fill that out correctly and make sure that the income that you make is the income you put down. You don't want to have a tremendous amount of write-offs. It's all about the ability to repay. Income qualifications are strict right now, probably going to get stricter as COVID ticks up here in the next couple of months.
Those temporary COVID overlays are making it more difficult, especially with rental income. Yes, they are. You have to prove the last 3 months that you continue to get your rental income. So don't let them pay you cash. Make sure that you put it into your bank.
Okay, good point. So check, wire, some form of payment that is recorded, and then making sure that those payments are on your loan application in a verified form, right?
Correct. So the COVID overlays are what we're worried because right now renters can negotiate for the last 12 months, and I think our California legislature wanted to make it even longer than that. And how can a landlord of 3 or 4 properties, if their renters aren't paying their rent, continue to pay his mortgage? So they're being very careful in that area right now.
Yeah, it's well, then they would have to also go into COVID. I'm not COVID, but in forbearance, and it's real. I don't know how they're going to solve that problem. Wendy, we're up against the clock. Appreciate it. Whoa, great information, by the way. Thanks. That was on top of it today. No kidding. I'm never going to prep you now, so forget. No way. No, that was great.
Always a pleasure.
Sure. Do you want to shout out your phone number for people if they want to get in touch with you?
Sure. If you have any questions, my number is 818-292-2572, and have a great day.
Wendy, thank you very much. That's Wendy Van Wessel from Stearns Lending. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to our show each and every week. We bring information about people, places, things, the ideas, whatever you need in terms of solving problems. You need a mortgage, or you need some real estate, or you just want to get through and buy that condo, rent out that apartment. There's a lot of things that we do on the show that can help you. We bring to the show great guests each and every day. We're on 5 radio stations in 3 different states. And we're on 8 big podcasts. They call them the Big 8, as well as The Mortgage Voice on YouTube. Michelle Wild joins us from Orion Lending. Michelle's been on the show many times talking to us about what's happening at Orion and some of the bigger pictures of what's going on both in Arizona as well as the country. Michelle, how are you?
I'm fantastic. How are you?
Absolutely the same. And thanks very much again for doing this. Kind of a crazy time we're living in right now, but how is it affecting rates or mortgage products, if at all?
Well, as far as COVID is concerned, we definitely had a shrink in the mortgage products that were available. You're starting to see that loosen up a little bit. As far as the election and everything that's kind of been a little chaotic there, the bond market has adjusted, and my thought is that we are going to see rates increase. We've had some truly historic low rates over the last year, and that's definitely not going to continue long term. So if anyone's wanting to make a move on a rate, I would definitely recommend they do that as soon as possible.
Can I ask you a couple questions about that? I often go back and forth with both guests on the show as well as my own opinion based on reading. It goes up because of the fact that the bonds are going to have to give more in the yield to get people to buy U.S. debt. Is that the reason why, or is it more of a fear factor? What do you target?
Well, it's a combination, I believe. I really do believe it's a combination of the fear factor that the economy, may not do as well with different tax regulations and different things that we're going to be putting onto the economy if, in fact, the numbers stay the way they are. And I think that businesses are nervous, and people who invest in the United States market are a little leery and just kind of watching. I think that it's going to be, and the other factor that's involved, and this is something that's really been different over the last few years, is what lenders can sell loans for in the secondary market. It used to be that if they have 2 options. You can sell directly to the agencies, the government-backed agencies, or you can sell it to another servicer. And it's the money that lenders get to do that is what covers what a lot of borrowers choose to do, which is have the loan officer be paid by through the rate. And the margins that are offered per rate stack are slimming and slimming over the last couple of years.
I think that's true, yeah.
That lenders make per loan. And the other big factor is the fact that people aren't keeping their loans long term.
Right.
In the old days, people would keep their loans and pay them off, and that was great. And then it went to about, every 10 years people would refinance. But it looks like right now it's about 2 to 3 years before people either move or refinance. And so lenders aren't having enough time to recoup the costs that are involved to even originate the loan, let alone make a profit.
Yeah, you hit so many great points that we talk about here on the show a lot, not as concise and as accurately as that, but that's actually what drives the mortgage market, right? And what we try to do is to find a place to sell these loans to make some money. And I think most loans are sold, $1,000 to $1,500 a loan. I think that's all these lenders are making. And so if we...
Very thin, very, very thin.
Very thin. And if we see an uptick in the rate that just means that fewer people are going to be able to refinance. Therefore, what's going to happen in the mortgage industry? Do you foresee next year maybe a bit of a consolidation?
I think that will. You know, we did see this year several very major mortgage companies go out of business. And, you know, since that time, earlier this year, we've had quite a few companies be very, very successful. And everyone is very, very busy. But, you know, as the refi portion of the market goes away, which eventually it will,
Of course.
I mean, if somebody is refinancing their loan into the twos,
right.
Well, if rates go up into the threes, why would they refi?
They wouldn't, unless they were in dire need.
For cash out.
Right. That's the only reason you would do that.
It's going to shrink dramatically in the next, you know, 6 to 12 months.
Now, you see UWM, United Wholesale, and Rocket Quicken Mortgage going public. How does that affect the competition like at Orion? How are you guys seeing what they're doing versus what you all are doing?
Well, you know what, there's a big difference. They so for Rocket Mortgage and Quicken, for example, they run in a different game plan. Both UWM and Quicken both go under the impression of most of their employees are more on the rookie side of the business, so they don't really value experience. And in the mortgage industry, experience is huge, especially right now when loans are very complicated. And what we're finding over and over again is we find borrowers who had gone to one of those two companies. As a matter of fact, they very frequently tried to do their loan at one of those companies and were unable to close the loan. They may have been working on their loan for 3 or 4 months. And then they get the, I'm sorry, I can't do your loan. And it's very devastating, especially for a borrower who may miss a window to lock a loan.
Yeah, no, I think that's true. Why don't you tell us what you're doing? What are you doing over to Orion to solve that problem?
Well, we don't hire anyone unless they have 5 solid years of experience in the mortgage business.
Right.
So we don't hire people right out of college. We don't hire people right out of any type of mortgage school. The people actually have to have experience. So unless they're doing like our data entry, we don't hire anyone who doesn't have experience.
Tell me some of the products that you're able to take advantage of by doing that.
As fast as possible.
What's that?
I said the key is to close the loan as fast as possible. So if somebody doesn't know what they're doing, there's a lot of mistakes that can occur. And when mistakes occur, it costs borrowers money. So sometimes the biggest name and the big commercial that you see on the TV or hear on the radio, they may not be the place to do your mortgage with. I would more recommend, I would highly recommend if borrowers were thinking that this is the time, I think now is the time I might want to refinance, I would highly recommend that you go find an experienced mortgage broker who knows what they're doing and has been in the business, I would say at least 5 years, and they can look that up under NMLS Consumer Access. They can see the experience level of the person they're working with. And I would only work with somebody that's been doing it for at least 5 years.
Oh, that's
they know what they're doing, and they will get the job done.
Now, that's great advice. I always tell people to shop around. Tell us a little bit about some of the products you're doing over at Orion.
Well, at Orion, we're doing, we have a couple of very unique things. We do all the standard agency products, FHA, VA, USDA, Fannie Mae, and Freddie Mac. But in addition to that, we have a down payment assistance program that is phenomenal. It offers people at a 620 FICO or better an FHA first and a down payment second. And it is a great product for somebody who might be a first-time home buyer or somebody entering back into home ownership that has been renting for a while. It allows people to get in without a down payment. And we work with the real estate agents to help get the seller pay some closing costs. And so that's a great way for people to get into the buying market. In addition to that, we just rolled out a new jumbo product that is priced phenomenally. And it is something that is going to allow people that are above that 510, 400 mark on their loan amount to get some incredible rates.
Excellent. Hey, listen, could you shout out your phone number for somebody who needs a terrific loan officer and a nice person too? Let people know how to get in touch with you.
Absolutely. My phone number is 602-663-6178. My email is mwild@orionlending.com.
Michelle, thanks very much for once again coming on, illuminating and educating everybody here on the show. Thanks a lot.
Okay. Thank you, Jeff. You have a great day.
You too, Michelle. That's Michelle Wild from Orion Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hey, thank you very much for joining me. I'm Jeff Barton, and welcome to The Mortgage Voice. We are on a number of different podcasts, the Big 8 podcast. We're on 5 radio stations in 3 different states, from Albuquerque to Las Vegas, Nevada, Inland Empire up to Lake Tahoe. We're looking to expand a little bit of that, so if you have interest in finding out about that, you can always email me, and my email address is jeff@malibufunding.net. Malibu Funding sponsors the show. It's a loan company, a real estate company in several different states, actually 13 now, and a silly season, which means we're in continuing education to get our licenses renewed. Now, I bring that up because many people in many professions have to do that, right? They have to do something on a yearly basis with which to keep their licensing. How are you affected by that? Meaning most of these continuing education, well, they're all online. Used to be able to go to live classes, used to be able to do live education in person. Can't do that anymore. And for those providers of that kind of education, those people are out of work right now. And in terms of people who need to get that done, get it done. I know for Malibu Funding, the company I work for, there's 100 or so different people who need to get this licensing on a daily, weekly basis. It's another stress at the end of the year that really just is amazing. There are so many stresses in most people's lives, especially if you haven't got a job and you're not working right now. I understand the stress. I really do. People in my industry have been affected, but because they're overworked, because the rates being what they are, have driven millions of people to refi in order to save money, because whether it's their job or the possibility that their job may be lost as a result of the pandemic, they want to make sure they lower their bills as much as they possibly can. And who wouldn't want to do that if you possibly could? Next year, we're looking at roughly 18.5 million people, if rates remain the same, that can be helped with a refinance. What does that mean for you? Are you in that pool of people who could be helped? What is your job? And when you get a loan, you need to prove your ability to repay, right? So that's really, really important in terms of making sure that you can get the refinance, being one of that 18.5 million people who can take advantage of it. And what is that advantage? On average, they say it's about $300. Now, that's important for somebody who needs the money. If you were a 2-family income, now you're a 1-family income, you might be able to still afford that mortgage because the rates are so low, and that savings of $300, that puts food on your table for a month. If you shop right and do it in a correct way, and that's a good thing for a lot of people. I was saying in an earlier segment about the stimulus, yes, I think we'll have one, but I don't know when and to what length it will affect and help you. I'm tired of people trying to play a political football with something which really should be about helping people. I'm not sure if everybody's on the same page with that, but that's where I stand and what I want to do. Some of the other things. When talking about real estate nowadays, it's very interesting that we've seen in some areas, especially down in Albuquerque, up in Las Vegas, 2 different and diametrically opposed. Albuquerque, we've seen prices improve down there, probably 5.5–6% this year. Whereas in Las Vegas, Nevada, yes, we've seen some improvements, but we've also seen, because the entertainment business is down, construction is down, that the actual income overall for the city, for the people that live there, is also down. Therefore, they're predicting a drop in real estate prices in Las Vegas, Nevada. So on the one hand, we have a rise. On the other hand, we have a significant fall that may hurt. Now, we've predicted this kind of stuff before on the show. And has it borne any fruit? Has it come to fruition? No, because last year was one of the most amazing last year. I'm saying at the beginning of this year, we were looking at a downturn in the overall economic activity, and we're looking at fall in real estate prices. Well, what happened? We had COVID. the Fed decided to purchase both mortgage-backed securities and treasuries, it dropped the mortgage rates to historic lows, and millions of people refied. We went from $1.5 trillion refi and purchase market in 2019 to $3.2 trillion in 2020. Now that's over double of what we had last year, which is, like I say, the people in the business are exhausted. It's really driven people to run and try to make that savings. I think that's a good thing for those people. But in terms of the overall real estate market, you can see one area of the country, another area of the country, two different stories. And that in and of itself will tell you a little bit about what's going on in 2020. Now, I wanted to talk somewhat about the transition from one administration, if it happens. Let's say it happens, okay? And I think it will. The difficulties that the new administration has with filling posts is that in the mortgage market, in the real estate market, we have oversight. We have heads of the Federal Housing Finance Authority, which really has control of, the regulatory aspect of Freddie Mac and Fannie Mae. Freddie Mac and Fannie Mae, as you know, buys all of the conventional loans, FHA loans in the U.S. Huge number, and those agencies, without oversight from FHFA, they don't have direction. Currently, it's a guy named Calabria has been doing it. He's been trying to push FHFA to allow Fannie Mae and Freddie Mac to be free of federal conservatorship. I think that's a good thing. The conservatorship in and of itself is not conducive for open market in terms of trying to make sure there's competition in the market. Freddie Mac, Fannie Mae, backed by the government, because there is a conservatorship going on due to the $165 billion bailout back in 2008. Fast forward 12 years later, what happens in the transition when we don't have, who's the new Calabria, or who's the new head of the Treasury, or who's head of CFPB, or who's head of any of these agencies, or who's head of HUD? As we all saw, poor Ben Carson contracted COVID, and now he's out. So who's really running the show over there? And by the way, I haven't heard a thing from Ben Carson other than once in a while. HUD is a really important agency when it comes to the ability and the affordability of housing in the U.S. FHA certainly, and how we expand the pool of people who can borrow while making sure that those particular agencies, FHA specifically, as well as Freddie Mac and Fannie Mae, remain solvent. That is really the job, I think, of the HUD secretary. But again, he's sick. So in the transition, what's happening to all these agencies is that we do not have a clear idea of who's going to step in, and so therefore, who's hurt? You, the consumer, the person who needs the loan, the person who needs some understanding as to what the direction of either oversight is, or what the direction of the funding from the Treasury is, what is the direction of releasing from conservatorship, what's HUD say about this? When we get into the individual who needs to buy a house, you're not going to know all this stuff. It's not going to be incredibly important to you, but the outcome is you, the mortgage rate, and what you pay, and what are allowed to be charged, and those oversights that give you the ability to be able to say, hey, wait a second, I need somebody to slow this process down so I can really understand what's going on. Now, we're in a great time in the mortgage business, but at the end of all of these cycles, there is a great deal of abuse. You will see that lenders will begin at some time in 2021 to tighten, because they're worried. They're worried about the product that they're selling back to Fannie Mae and Freddie Mac. They're worried about the consumers, because consumers are used to these low rates, and maybe people should not be lending or borrowing money that they are currently being allowed to. All of these things are going to happen in 2021. And I think not having the ability to transfer agencies from one group to another group, one administration to another administration, really exacerbates this particular problem, because we need really seamless oversight, seamless direction, seamless leadership in all of these departments. The slower it happens, the wider the gap between getting someone up to speed and allowing them to be able to step in and hit the ground running is an invitation to this type of problem that I saw back in '08, and now I see now. Anyway, rates are still great. Real estate is still very tight. And all of those things are not going to change today. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.